Jorge Montepeque, president and founder of Global Markets, the last one to turn off the lights in Singapore this week. Jorge, are we going to return to planet Earth once everybody wakes up and remembers that every barrel that Saudi cuts is an idle barrel of capacity, and now they have 2.5 million barrels of idle capacity? What's all the fuss about?
Well, first of all, hello to everybody. And Sean, great to see you. It's great being here in Singapore and getting a sense of the market. So let me share some of the highlights. Number one, the Chinese are everywhere. So if you see the attendance is heavily, overwhelmingly Chinese. The role of the Westerner, or Angmo as they call it here, is definitely sunsetting, if I may misuse that word. In years past, it was definitely the other way around. And there was some very serious, heavy politics going on. There are market things, but there are greater political things. And I'm going to be, as per normal, very open and honest in my views, in what I have seen and how I have, in a way, validated that in various conversations. And number one is that there is a low to medium level rift between the US and Saudi Arabia. And there is a medium to high rift, or medium to, or high to extremely high rift between the US and Russia. There's a fight of various levels within those two countries. And in the discussions I have been having with various market observers, producers, major Western oil companies, is how can you, meaning US, win a battle against 20% of the world oil supply, which Russia and Saudi Arabia are? And if we're very honest in that assessment, is you have no chance. Really, you have no chance. You have to be very fair and say you have no chance. And if you extend that battle to Iran, Venezuela, and maybe you know, well, you must know, you do know about the delegation coming in from the US to the UAE this week to tell them, don't do that, meaning don't sell to Russia. That 20% starts to grow massively, right? 25, 30%. You cannot win. And what we have seen in the OPEC and among this OPEC Plus is that they do have not full 100% discipline, but some level of discipline. And this is evidence on the price. The price is, for all practical purposes, $90. If you add the premiums that crude commands, in effect, 90 plus at the moment. And if it were left to its pure market devices, it would be, of course, lower because there would be more supply in the marketplace. But the major oil producers are telling, in effect, to the US to back off a little. Don't push it too hard. Recognize your place in the ranking. It's better for all of us to be friends than to be fighting. The kingdom is fighting. It's the reality, right? And maybe, well, you did see that today. The Bank of China also opened a branch in the kingdom. So it's imminent that we are going to have a petro yuan. It's imminent. It's happening. We need to realize all these things. And meanwhile, the Western economies are shrinking, are suffering, mega suffering. And China as well is suffering. But at the top is, of course, Germany. And I don't know if your speakers have highlighted those issues with Germany. So from where I stand, the best thing would be to everybody have a, kumbaya, huddle up and say, let's stop fighting, and that will help the economy grow. But in the meantime, as demand drops in key centers and grows in the global south to a net effect of growth, let's not forget that there is a net effect of oil demand, Saudi Arabia, Russia are willing to turn off the taps somewhat, and that will ensure that gasoline prices remain high, and just to put it here as politely as I can, remain high prior to the US election season.
Jorge, looking at the point you finished on, the gasoline prices in the U.S. going into the next sort of 12 months with the presidential election, but already the current price in September appears to be at whatever 10-year highs for seasonality or something, puts it in a very high place already. I wanted to get your thoughts on how much of that is structural, not so much crude related, but ultimately refining limitations, and sort of dovetailing that with the opposite, the Chinese now importing a lot of oil, but also going to be exporting a lot of products. Where do you think products go globally from the point of view out of China, and then consequently what impact that can have on other markets like in the US?
First of all, let's put aside a little bit of the issue that there is inflation, and the inflation will continue, and therefore you will see higher prices just because of inflation.
Oil is cheap.
Let's put that aside. The issue is that the market has come back because COVID is behind us. Everybody's flying. Everybody's trying to start business. Yes, you're even more bearish than me. I think Germany has a heartbeat, very slow, but it has one. Not zero. So things have come back and demand is very high, right? It's 103 million equivalent per year, per day this year. Very, very high. So refineries have had a great time making money because Russian oil gets knocked on the head, is a little bit cheap. They have high margins, just run. And that means they have been postponing turnarounds. And the turnaround season is finally here with us. So as the turnaround season starts coming in, that's going to further open the cracks, which means that the drivers for the price is not at the margin, it's not actually the Saudi crude cut, or extension of the crude cuts, is the absence of, at the margin, a barrel of oil. So gasoline and diesel are going to be driving this market for the next quarter. So we should expect even higher prices rising faster than crude over the next 6 weeks. And that is as we enter the winter. And I think everybody was hoping that Russia would keel over and give up. But what we are seeing is that the US is the one that gave up by buying crude for its SPR. Note that the US used the SPR to force a market change and a market concession by the Russians. It failed. The US has to buy back. So the whole environment, politically, economically because of inflation, and the demand return points to higher prices with products leading the charge.
I wanted to get your views on elasticity of demand, which I think is relevant now because obviously the economies are not in a trajectory that would indicate your standard global 2 million barrels a day demand increase, sort of historical average. The demand, even with the U.S. economy and the seemingly doing well, we're forever hearing we've got full unemployment, but everybody's economically miserable. There's a weird counterintuitive reality now, putting aside China, but ultimately in the G7 OECD, there's full employment in most of the OECD countries, and yet there seems to be nobody can live in the city of London because they can't afford to live there, even though they have a job. Irish people are emigrating not because they're unemployed, because they can't afford to live in Dublin. That there does seem to be this, macro numbers are relatively in a reasonable place, but the actual living crisis is there. So elasticity of demand going forward in a weaker economic outlook, 103 million barrel oil day market holds up, do you think?
Yeah, and this brings us back to the issue of inflation. We we have to recognize that the price of oil cannot be low while the price of an air ticket is high, the price of rent is high, the price of eggs is high, the price of everything is high because the whole environment is rising because of inflation. And this brings us to two very critical comments. Number one, I did speak to producers this week, and without pointing the one, they are committed to maintaining the cuts to ensure that the price remains robust. And based on my body language interpretation, they're extremely committed. Number two, the interest rates, as they have risen, they are damaging investment and economies. And in particular, let's not forget that, the already developed established economies, because they haven't dealt with high interest rates for decades. But for the emerging world, that's every day. You know, what are interest rates in India, in South Africa, in Guatemala, Mexico, whatever? High, right? So they're a little bit higher. So at the margin, the change is not as damaging. And that means that the global south will continue to grow while the developed world gets hit. So on a numerical basis, as we enter 2024, the central bank authorities will be in a very hot seat of keeping interest rates high and seeing their economies lose their heartbeats or inflate. And the discussions we have had here in Singapore is, do you prefer to be facing an unemployed angry man that cannot buy eggs, or do you prefer to face an employed angry man with inflation that has to pay more for eggs? So the end result to us mentally, intellectually, numerically, is that the world will be inflated next year. So as the world gets inflated, yes, the oil price, the price of products, the price of everything will go up. So I hope that kind of gives you the sense of what is coming. I think it's a very high price environment for 2024.